answered. Now we're going to move on to Mr. Wes Frank. I'm very excited to be able to introduce Wes because when I spent time working at the Southwest region office, the headquarters, I got the chance to work with Wes Frank, and it was he was one of my favorite people to work with. So let's talk about Wes Frank. If you guys aren't familiar, what's exciting about Wes Frank is that his very first appointment as a Cutco rep was done as a group demo at his cousin's graduation party. Not surprised, Wes, that did not go well for you. He said that nobody was interested. Really, it didn't go very smooth outset. After that, he started listening to his manager, and here he is today, one of the top division managers in the entire company. So good thing that he made that transition early on. Now, Wes has always been known as being consistent and professional and enthusiastic. The people who know Wes best know him to also be a person that treats other people right, a very committed father, leader, husband, very empathetic, and very professional leader, of course, avid learner as well. Wes is at $66 million in Cutco career sales at this point. He runs the Rising Sun division. Rising Sun division sold just shy of $5 million last year in FSM business, and they had a 57% growth in their FSM business last year over the previous year, which was awesome. Had 4 new Rolex winners in their division. They had lots of new babies and family growth, which he's excited about, and lots of his FSMs and CSPs saving money and investing in big things, which has been really great to see. So he's here to talk to us today about finances. He's been able to learn a lot about investing and saving. He's been able to learn a lot. It's one of the subjects he's really interested in. So he does always learn more about it, but he's also implemented those things himself through the money that he's made with Cutco for the last 20 years to really set himself up for financial freedom, which is really exciting. Wes loves tennis and golf, watching sporting events, especially Philadelphia sporting events. He loves going to the movies. He loves date nights with his wife, of course. And when I asked Wes if he could be part of any movie or TV series, which would it be? He said 24, if you're familiar with 24 and Jack Bauer. He didn't say he'd be Jack Bauer. He said he would be Jack Bauer's sidekick. We're going to let Wes take it away. Thank you, Wes.
All right, awesome. Just a quick thumbs up that you guys can hear me okay would be great. All right, fantastic. I'm going to go ahead and share my PowerPoint here. And great. Well, I am very excited to be with this group. First, a quick disclaimer. So, nothing that I say here should be considered financial advice, of course, just my opinions on things. But I'm really hopeful that this message is going to cause you to maybe ask better questions to your advisors and your peer group, and maybe be exposed to more of what's out there. I'm hopeful that there's going to be at least one thing I talk about that is going to be new for you. So there's not a lot of time today. We're running a bit behind. So for me to go super deep on any of these topics would take a long time, but I'm going to try and hit on some highlights here that you can take notes on, and then maybe it encourages you to research it more. And ask your advisors about it. So I think a good starting point would just be where this group is at in terms of how much you expect to save or invest this year. Thank you for those of you who filled out the survey that was sent out. Here's my takeaways. From this, 88% of you expect to save or invest at least $30,000 this year. That's pretty exciting. And 57% of you expect to save or invest at least $50,000. So more than half the group expects to be over 50 this year. And 8% of you expect to save or invest over $100,000 this year. So that's very exciting. And I know not all of you got a chance to submit your answers, but the question is, what would it look like for you to jump up to the next savings level this year and add an additional 10, 20, 30K plus to your savings this year? Maybe that means working a couple extra events this year compared to last year. Maybe it means, maybe it means doing a couple extra days of service calls, during the week, in between events. If you don't know what that answer is going to look like, then you won't be able to make an educated choice about whether that extra work would be worth it for you, right? So you got to know what the trade-off is and what it would mean for you, both in terms of what you're giving and what you're getting, right? So expanding the gap between how much you earn and how much you spend, that's the name of the game. So in some talks that I've given in the past, and I've given, probably 10 different financial talks nationally over the years, in some of those talks I've talked about cutting expenses, right? Not eating out as much or making your coffee at home. That is not my message to this group. Okay, so for this group, it is much easier and also more pleasing lifestyle wise for you to increase your income than it is to nickel and dime to cut your expenses. So of course there, are, if there's some unnecessary things that you're paying for, we can all benefit from doing a review or an audit of our expenses every few months just to cut out some fluff. But I think that a lot of people end up letting money sit in their checking accounts for too long, not knowing where it should go, and they get more complacent when their account is bloated, and they get more scrappy when their account is feeling low. How many of you can relate to that, right? When the account is, dwindling a bit, it's like, I got to get my crap together and get back to work, right? I got to add some extra days. I'm going to pick up some extra shifts or whatever that looks like for you, right? So I would suggest looking at your income averages from the last few years. Which are the months that are your outlier months for your highest income, right? And can you pick a few days a year in the calendar when you expect big paychecks or big monthly bonuses and already have it in your calendar when you're going to be saving some bigger chunks? So putting it into your calendar in advance, send 6K to my Roth, or send 10K to my solo 401k, or pay off my credit card debt. Can you plan that months in advance because you have a general expectation based on the flow of your income from the historical balances, right? So when I get a bonus from Cutco into my account one day, it's typically out of there within 48 hours and into some type of investment account, because I know what happens if I let it sit there, right? We find a way to spend it, or we become looser in our spending habits, or we take our foot off the gas a little bit in our business. And so a little bit about my history. Like I said, I've given a bunch of financial talks at SLCs and RDCs over the last decade plus. And so the info in those talks is still applicable. And so if you want to watch those recordings, I'll give you the link for those, and I'll get that out to you after the message. But I will say that my strategies have evolved a little bit as I've gotten exposed to more investment opportunities, but most of the principles are still the same. And so I started out with more traditional investing in retirement accounts, starting at age 20 with Cutco. I funded Roth IRAs and solo 401ks and traditional IRAs for many years in the business. And we eventually, my wife and I, eventually got to the point where we were socking away over $100,000 a year for many years. And in most years, we maintained a 50% plus savings rate on our combined take-home income. So when we were earning 200 grand combined, we kept our living expenses to under 100 grand and invested the rest, right? So think about, hey, not just how much of my savings, but what's my savings rate, right? What percentage of my take-home money am I putting away every year? Okay, so the next thing I want to talk about is becoming an accredited investor. And so about 10 years ago, I learned about this. And most wealthy people will tell you that their best investments were only available to accredited investors. So what does it mean to be accredited? Well, the government says that some investments should be restricted to sophisticated investors. Its purpose is to protect newer investors who don't know as much about vetting deals and doing due diligence, from losing their investments. So it's there as a protection. But many of the best deals and funds that you can get into out there, you need to be accredited in order to invest in. So how do you become accredited? Well, there is no test or quiz, right, for them to say this person's a sophisticated investor. It's purely based on income or net worth, which is pretty silly, because I know plenty of rich people who aren't very sophisticated with their investments, but that's the way it is. So here's what the qualifications are. It's a household net worth of over $1 million, not including the equity in your primary home. So that's one way to qualify. Or 200,000 in income in each of the last 2 years, or 300 grand in combined income with your spouse for the last 2 years. So how do you prove it? Well, honestly, it's not very strict on verifying. It's up to the company or the fund that you're investing in. The onus is on them to make sure all their investors are qualified. But here's the way that you can basically prove it. You can just go on Vector Connect and go to in the financial section in the tax forms, and you could just take a screenshot of your last few years of 1099 totals. That's usually plenty to prove accreditation there. So your CPA or your financial advisor can give you a letter, or you can do it yourself at verifyinvestor.com. And usually uploading that screenshot is plenty. So I know not everyone here would qualify yet, and that is totally fine, of course. It's a really high bar to be accredited, and there are still plenty of amazing things you can do with your investments. But maybe knowing what this level is might help you to shape some of your income or savings goals in the coming years, right? Because once I became accredited, it started opening different doors for me. And, I joined the local angel investing group here in Arizona. Think of like Shark Tank, but there's like 50 investors in the room. And, over the next 4 years, I invested in early stage in 17 different companies, basically taking home run shots of small, relatively small, bet sizes at a time. And, typically 7 to 10 years to see any kind of return on those types of investments. So it's really high risk investing, but it also has the potential of really high rewards. So the idea there is that 1 out of every 10 make up for all the losses and then some, right? So now that I know what I know over the years, I wouldn't recommend that as a starting point for your alternative investing. It just so happened to be my gateway into kind of getting exposed to more exclusive rooms and networking with more successful people, being exposed to different books, different podcasts. Plus, it's fun learning about cutting edge technology and hearing from big thinking founders too. So as far as returns go, we won't know for a few more years whether I had a good eye for it or not, but some of them are looking pretty promising. So we'll see. After that, I started doing some more cash flow deals and private equity. And I didn't even know these types of deals existed, 10 years ago when I was coming up in the Cutco business. But, there are deals that are what we call debt deals, right? Meaning that they will pay you a monthly interest payment. And then when the term is up, you get your entire initial investment back. And then on top of that, you are left with a piece of equity in the company after all your money is already out of the deal. That's called getting an equity kicker, right? So one of the deals that I did was, I put in $50,000, which was a big bet for me at that time, right? And it pays 20% interest a year. So that means it pays $833 a month so that I get consistent cash flow. I get back my 50K after 2 years, and then I'm left with a piece of equity in the company at the end. So it's the best of both worlds, right? I get cash flow, but I also get a piece of the upside in the company. So real estate is great. Personally, I don't have much of an interest in owning like a portfolio of rental properties if I was going to self-manage. So for me, I prefer investing in multifamily funds instead, and many of them will pass on a lot of the same tax benefits to the investors in the deal. So you get a lot of the tax benefits of owning real estate in a more passive way. And some of those deals have some great returns and maybe a little less work than owning and managing your own properties. I do know a lot of people who own their own properties and they really enjoy it. So that's great too, if that's something that you have the bandwidth for. So what does a diversified portfolio look like? I thought this might be beneficial to see. Here's an example for you. It's really good to have both a current allocation and a target allocation so that you can see where you're too heavy, where you're too light, and that way your next investment dollars, where do you want to be putting more towards in order to get back to where your balanced target is. So a good advisor can help you with whatever your mix is. By the way, these targets are just my current targets. Yours will look completely different based on your risk tolerance and your preferences of liking certain asset classes more than others, but I wanted to show you an example. So for me, my next investment dollars will go heavier into the areas where I'm currently below my target percentage, right? So anyway, this, and I'll give you my PowerPoint later, so you'll have access to this if you care to check into this more. So let's get into the topic of taxes and current events here. There was a lot of interest in this topic in the survey, and you've probably been hearing a lot about inflation recently. Check this out. 80% of all US dollars in existence were printed in the last 22 months. That is insane, right? From $4 trillion in January 2020 to 20 trillion in October 21. So what does that do? Well, when you're printing so much money, the purchasing power of a dollar goes down, right? The cost of buying goods and services and steel for knives goes up, right? And during inflationary years like what we're going through, it's a time when salaried employees are at a disadvantage, and independent contractors with no income cap have the potential to really win if they take advantage of it. So if you want to sell more to keep up with inflation, you can just add one extra show to the schedule for the year, right? If my wife, who's a W-2 employee, wanted to keep up with inflation, she would need at least a 6 to 8% raise this year, which is not normal at all. The average salary raise is 2 to 3% a year. And so, but really anything less than a 6% raise, and she's probably losing money this year, right? So in a period of inflation, savers are losers. So here's what I mean by that. Keeping money sitting in cash or in savings or in a checking account and just stockpiling instead of that money being invested, that money's going to lose value. So even a high interest savings account only earns around 1%, let's say, but when your money is losing 6 to 8% of its value a year in purchasing power, that means that that money can buy less stuff with that dollar than you would have been able to buy last year, right? So sitting on it in cash under your mattress or in a checking account, that's like letting it melt away slowly, right? So here's what I'll say. Some people are afraid to invest their money because they're nervous that if they invest it, it might go down. But the truth is that if you're not investing it, you're just guaranteeing the loss, right? So there's a sliding scale here. So saving under your mattress is better than not saving at all, right? And saving in a high interest, savings account is better than under the mattress, right? And investing is way better than saving. So I'm not saying that saving is bad, right, by any means, and any progress should be celebrated, but there is a sliding scale of more and more optimal strategies based on how educated and experienced you become. So here's what we know. Tax rates right now are at historical lows, okay? So and we're talking about U.S. U.S. income tax rates here, federal. So the national debt and the government's obligations are continuing to grow. Over the next 7 years, another 60 million baby boomers are going to be retiring over the next 7 years. That means leaving the workforce, right? And that means less tax dollars from salary, right? Less tax dollars will be coming into the government's budget each year. And those people will all begin collecting Social Security and Medicare for the first time. So that means 60 million people are going to switch from being assets to being liabilities on the government's balance sheet. So the question then becomes, do you expect tax rates to go lower or higher in the future? There's really only 3 ways to combat growing debt and obligations, right? Number 1, drastically cut government spending. Fat chance of that, I think, right? Print even more money. That's the second option, which risks hyperinflation. Or raise taxes, right? So if you buy into the idea that taxes will have to go higher in the future, like I believe, then that should inform your investment decisions. So most people in the country invest into traditional 401ks that are offered through their company, right? And so I have a question for you. Would you ever have a business partner that tells you, I'm going to tell you what percentage I want of our business later, when the business sells? That's when I'll tell you what percentage I want of our business, instead of when we first become partners. Would you go into a business partnership with that person? Probably not, right? So, but basically that's the deal that people make with the IRS through their traditional 401k plans, right? They put money in. The IRS says, hey, we're going to let you put this in without paying any taxes on it for now. And then we'll split the growth later in your 60s when you take it out. And we'll tell you later what percentage our cut's going to be when you take it out, right? So the question is, if you believe in the idea that tax rates are going to be higher in the future at the time of your retirement, does it make more sense to pay the tax on it now when we know that taxes are at historic lows, instead of crossing our fingers that you'll be in a lower tax bracket when you retire or the tax rates will be lower when we hit our 60s, right? So because of that, I think it does make sense to look at a couple tax-free investment buckets, which many of you said you wanted to learn about. So here's my 2 favorite tax-free investments. The first one is a Roth IRA. So we pay tax on it when we put it in, and then it grows tax-free, right? So in this group that I'm talking to, many of you either don't have a Roth IRA or your Roth IRA is the smallest account of what you have, right? Well, why is that the case when I'm talking to a higher earning group? Well, a couple reasons, right? There's some myths. People think Roth money is locked up until retirement. They think they earn too much money to be eligible, or they think, hey, I already maxed it out at $6,000 a year. I can't put any more in. They think that they can contribute more money to other investments, so why mess around with a smaller account? Or they think you can't do other things like real estate or alternative investments with a Roth. Well, all 5 of those statements are false. So let's unpack those a little bit. Number 1, I make too much money to contribute to a Roth. There were caps on contributions and conversions, but most of those limitations have been removed for now. There was a proposed bill in Congress in 2021 this year that included limiting conversions, but it didn't pass. So for now, Roth conversions are still available no matter how much money you make. Number 2, contributions are limited to $6,000 a year, so it's not much money, right? Well, I know a lot of people who put in over $100,000 a year into their Roths. So I'm not going to get into the weeds here, but look up something called a mega backdoor Roth IRA. All right, if you want to learn more about that. Myth number 3: a Roth IRA is an investment. Well, a Roth is not an investment. It's a financial umbrella. So you have this investment, and the investment gets rained on. That's considered taxes, right? Well, if you take that same investment and stick it under the umbrella, then they don't get rained on, right? No taxes in the future on that investment. A Roth is not an investment. A Roth can protect anything. This can be stock market investments, right? Which is the way 99% of people invest their Roth money, or it can be real estate, it can be alternative investments. So you can do all kinds of investments by being protected by a Roth. So myth number 4, a Roth can only be invested in the stock market. We just talked about that. Most company 401k plans only offer stock market, options. But like I said, you can do real estate in a Roth or anything else, angel investments, all kinds of stuff. Myth number 5 is you can't take it out until you retire, and I don't want my money tied up that long. What if I need it? You can take out the money anytime you need, at any point with no penalty, only your principal. So whatever money you put in, you have access to, but you don't have access to the growth, okay? So you can also take it out with growth for buying a home or for college for you or a loved one, or for starting a business without penalty as well. So there's not as many restrictions as some people think. So to learn more on that, you can read my buddy Will Duffy's book. It's called Roths for the Rich. This is an excellent book if you're interested in learning more about that. Okay, the next one, my other tax-free investment, is whole life insurance. Now, whole life insurance that is expertly designed, okay? So I will start by saying I am not a fan at all of most whole life insurance. It's normally a really expensive way to give you a death benefit, and it takes a really long time to build up the cash values. The commissions to the people selling it are through the roof. It's why I only did term insurance for many years, and it's why people like Dave Ramsey and others will tell you to run for the hills. But there is a specialized way to design these in a way where it's the only asset class that can be income tax-free, estate tax-free when you pass it down, and still be accessible to use during our lifetimes. So these are not off-the-shelf type of policies, so you need to seek out experts if you're interested. But with life insurance, here's what's cool. It can be used almost like a bank. So $1 sits in the policy and it's earning interest and dividends, nothing crazy like 4, 5, 6%, but it's consistent. And then you can leverage that same dollar by borrowing against it at a really low rate. So you can get a 3% loan using the money in your cash values as collateral. And then as long as you're earning more than 3% on whatever that investment is, then you're arbitraging the transaction there, right? And you're getting more than what you're borrowing. So They're banks that will give you a very low interest loan using the cash values in your policy as collateral. So big disclaimer here, most whole life policies are garbage. So if a former Cutco rep who now works for Northwestern Mutual calls you, you can politely decline. I get hit up every single year, but there's a very small percentage of people who know how to craft these the right way. So do your research or read some books on it. If you're interested in learning more, there's a great book and a podcast called The Power of Zero. It's by David McKnight. So this can give you some more info on that. All right, let's get into 6 tax savings power moves here. Again, I know we are timing wise. If you need to bounce, I won't be offended. But for those of you who are interested in this stuff, I'm hopeful that it's going to give you some value. So 6 tax savings power moves. Consult your accountant. Not all of your CPAs will be on board with all of these strategies, but it's good to know what's out there and what others are doing. Run it by them. What really matters is if your accountant would feel comfortable justifying the strategy for you in the case of an audit. So number 1 is called a defined benefit plan. You've probably heard of our parents' generation having pensions at their jobs, right? Well, if you're incorporated, this is a pension plan that you can set up for yourself and your employees, right? So it could be a great strategy for higher earners. You get a dollar for dollar tax deduction for the money you put into it every year. And once that money's inside the account, you can then reinvest that money into either stock market or other deals like real estate funds or things like that. The fees on setting this up are high, but it could be worth it because of the tax savings. So I'm not going to dig into that one in a lot of detail, but it's just something to jot down and ask your accountant about or your CPA. This one you guys are going to love. This is called the Augusta Rule. This one is really cool. Do any of you ever host business-related events at your house or events team meetings or karaoke in the backyard, Amy and Josh? So your LLC or your corporation can actually pay you, the homeowner, personally for renting out your home to your business to host business events and meetings. And that income is a write-off for the business, but that income is also tax-free for you, the homeowner, personally, as long as it's 14 days or less per year. So if you ever host at your place, you can get Airbnb comparison rates for how much it would have cost you to run that event at a comparable home elsewhere in town, right? And so what's cool is that if you live where big draw events come into town, you can get comparable rates from around those times a year. So in Scottsdale, every year we have the Phoenix Open golf tournament and spring training games for a bunch of teams that are played here. Well, Airbnbs for homes around my size go for $2,000 to $2,500 per night, right? Times 14 days, that's over a $28,000 deduction that I can take by running an event, by running events at my house. So as an example, Wes Frank and Associates can rent out my home from Wes Frank the individual in order to run that meeting or staff meeting at my house. Now, here's what's cool. If someone else who lives with you is also part of your business, it might not take a whole lot of planning for you to organize a board meeting at your house for those days, okay? So that's the Augusta Rule. Talk to your CPA about that one. Next one is called the Section 179 deduction, okay? So Section 179 of the tax code allows your business to write off the entire purchase of qualifying equipment for the current tax year. And I'll put this up on the PowerPoint in just a second. But both new and used equipment qualify for this deduction as long as it's new for you. So it just has to be used for the business at least 50% of the time. So what type of equipment am I talking about? Computers, printers, office furniture, copiers, things like that. Here's the big one. Vehicles. Any four-wheeled vehicle that is more than 6,000 pounds in gross weight, you can take what's called bonus depreciation for the entire cost of the vehicle your first year of using it. So let's say if you buy or finance a vehicle that's over 6,000 pounds to schlep home show booths around, you get to write off the entire purchase price in the first year that you're using it. So that does not mean you don't have to pay for it, right? But you can deduct the full cost from your income on your taxes in the first year. So talk to your accountant on that, but think about this, right? it's no surprise that like Tesla Model X is so popular with doctors and accountants and financial advisors and small business owners. And it just so happens that it's over 6,000 pounds in gross weight. That's not an accident, right? So, by the way, that doesn't include the $7,500 federal tax credit for buying an electric vehicle. So you add those two things together, and for some business owners, after the full tax deduction plus the $7,500 tax credit for going electric, this actually makes a Model X less expensive for them than a Model 3 would have been. Pretty interesting, right? So that's section 179, so you can check into that. All right, next one. I love this one. Putting your kids on the company payroll. So paying your kids a salary. The limit is up to $12,000 a year without them having to pay any income tax on that money. So your business gets to deduct the full amount that you pay them from payroll for your business on taxes. The work has to be legit and age appropriate. Okay, so your kids, so what does that mean? Well, your kids could be on your website as models. They could make appearances in your sales emails, right? They can also help take out the trash and help clean up your home office. As they get older, their duties can evolve, right? As, you know, with the business. So they can help with social media or market research. So to make this even more powerful, you can then take that kid's income and you can put it into a custodial Roth IRA in their name. Imagine if you started a Roth IRA at a young age and how much it would have grown to with an extra 10 or 15 years head start for compounding, right? Well, I'll tell you, $6,000 a year starting from age 10 is $3 million plus by age 65. Right? Now, they can contribute, by the way, they can only contribute to a Roth if they have earned W-2 income. So they wouldn't be able to do this unless they were an official employee of your business, right? So, but eventually they can make the annual contributions to their Roth completely on their own in high school or during college, but that head start can be really powerful. Next one is called backdoor Roth. So this is a way to get an extra $6,000 into your Roth every year. Basically, you put money into to a traditional IRA, you convert it into a Roth, you pay some taxes on the conversion, and you're done. So even if somebody makes, let's say, too much money, right, to contribute to a Roth IRA, yeah, you can always go and do a backdoor IRA anyway, no matter what your income was. So, so that's that. Next one is number 6. This is the charitable giving fund. Let's say you usually give $5,000 to charity every year, okay? In a big earning year, when you want to reduce your taxes, you can contribute a larger amount to your donor advised fund. Let's say you put, hey, I'm going to put, I know I'd give $5,000 every year. Well, let's say I give $15,000 to my donor advised fund. I get my full $15,000 in tax deduction for that current year. And then over the next several years, I can have $5,000 checks, cut to the charities that I want to donate to. But in the meantime, I get the full tax deduction up front, and that money can be invested while it's in there, so that money's growing, right? So that's a cool thing. So that's called your donor advised fund. Basically, it gives you more control over when you want your deductions for charity stuff. So, all right. So a bonus tax tip that I'll give you is use a good bookkeeper. I use MyBooks Pro. If you're incorporated, making sure that the books are in order is really important. If I didn't have somebody putting the numbers in front of me throughout the year, I'd be so scattered. So their website is mybooks.pro. It's run by Adam Stock and Robert Gonzalez, former Silver Cup winner. They understand the Cutco business, of course, and our expenses and our deductions really well. Pricing is very reasonable compared to most bookkeepers, and I will say that they have some discounts available to CSPs if you're interested. All right, so a couple last things here. I do want to briefly touch on crypto. I will say I don't think this is a fad. It makes sense to learn about it, even though this wouldn't be my first place to invest if you're just getting started, because it is risky stuff. It probably does have a small place in most people's portfolios as long as they're already in a comfortable position. There's a few ways to invest in the space. HODL, you may hear, that's hold on for dear life. It's basically taking bets on a bunch of different tokens or coins that you want to hang on to for the long-term holds because you believe in the long-term value that the price will go up. There's another approach called the shotgun approach. Basically, it's just taking a bunch of smaller bets at 10 or 20 really low-priced altcoins and just sitting on them for years and just crossing your fingers that something pops, right? So that's kind of like buying lottery tickets, but all the big coins had to start somewhere. And then the next one is passive income DeFi projects. I would say this is probably the area of crypto that I'm most excited about in the space right now. I will tell you, I'm currently earning about $15,000 a month from a mix of crypto passive income cash flow projects. From only around 35,000 total invested, and it's bringing in about $15,000 a month. So again, this is not financial advice. I'm not an advisor, but that 15K a month could quickly turn into 5K a month, right? Or it could go much higher, right? So I got into a few different passive income projects that have been pretty interesting, and there's a lot of risk to all of these, so I wouldn't put money in that you're not comfortable losing completely. Or if you're the type of person that will be anxious, like seeing big swings in price on a daily basis. But that risk also comes with the potential for outsized returns. So that 15K a month, that's like 180 grand a year on a $35,000 investment, assuming all these projects remain stable, which they absolutely will not, right? So prices go up and down by the minute. Some of these projects, might not even still be around in 6 months, but for now, it's pretty cool. So again, not an advisor, and this is just a fun money project for me to learn about, but and putting in less than 10% of my total investment dollars from 2021 into this. So it depends on your crypto knowledge and your risk tolerance and whether you've already hit your other investing goals. So you probably heard about NFTs. This is not just owning a picture. The images can come with ownership value. It can come with backstage passes. It can be tickets to events, right? 5 years ago, if an artist sold a painting, it was a one and done transaction. But in the NFT world, an artist now controls the rules. They can say that, hey, yeah, I'm going to sell it to you, but then every time this gets sold to somebody else and somebody else and somebody else, I get a 5% residual on any sale down the line. That's pretty cool, right? Puts artists, more in control of their own work. I think that's pretty neat. So these on the screen right now are part of a collection called the Bored Ape Yacht Club. You may have heard of it. The cheapest ones right now are going for $235,000, the cheapest ones. Pretty wild. So Jimmy Fallon owns them, and there's bunch of other celebrities, right? So Gary Vee made $90 million in 90 days from NFTs that he launched last year. By the way, 9 months before that, he had never even heard of NFTs. So pretty wild. So the last thing that I will wrap up with here, guys, I would say money is the cheapest that it's been in decades right now. And as interest rates start to go up over the next year or two, things are going to change. So, but now is the time to get as long of debt terms as you can. So if you have a choice between a 30-year fixed loan or a 15-year, I would go with the 30, right? Lock in a rate for a longer term at a low rate right now. Don't be in a hurry to pay off a mortgage early if it's sitting at under 3% interest, unless you already know that it's purely for peace of mind purposes, right? If you're sitting on a bunch of equity in your house and you can get a HELOC or you can get a cash out refi at a low rate, that might be something that you want to consider so that you have access to that money to be able to jump on different investment opportunities. So guys, I know this was a lot and briefly touching on a lot of different topics here, but hopefully you heard at least one or two things that spark some interest, and maybe now I encourage you to go research more and see if any of these things make sense for you, and or some things to look forward to in the next few years after some big years in Cutco. So or maybe just some good questions to ask your advisor or your CPA about. So thanks, guys. I really appreciate you having me. I love this group, and I know many of you personally, and for those who I don't know yet, I look forward to meeting you at some point. So thanks, Amy and Josh. Appreciate it, and thanks, Dave, and everybody else.